Breaking. The London precious metals market just witnessed something absolutely catastrophic. HSBC, one of the world's largest banks, has issued an emergency board directive that's sending shockwaves through the entire financial system. Here's what you need to understand. Right now, internal documents reveal HSBC is frantically attempting to exit a staggering 7.3 billion ounce position before January 31st. That's not a typo, billion with a B. We're talking about roughly 347 per ounce in what appears to be a complete liquidation scenario that threatens to unravel the entire London Bullion Market Association structure. The question isn't just why the panic, it's what do they know that we don't? This isn't a routine market adjustment. When a banking giant of HSBC's caliber issues emergency exit protocols on this scale, it signals something far more serious is brewing beneath the surface. The LBMA, which has stood as the bedrock of global precious metals trading for decades, may be facing an existential crisis that could reshape the entire metals market as we know it. In the next few minutes, I'm going to break down exactly what's happening, why this January 31st deadline is absolutely critical, and most importantly, what this means for your financial future and portfolio positioning. If this information is valuable to you, smash that like button right now. This story is being suppressed, and we need to get this out to as many people as possible. All right, let's dive deep into what's actually happening here, because this situation is far more complex and, frankly, more disturbing than most mainstream financial media is willing to discuss. We are witnessing what could potentially be one of the most significant structural failures in the precious metals market in modern history, and the implications stretch far beyond just gold and silver prices. This is about the fundamental architecture of how global commodity markets operate, and when that architecture starts showing cracks, everything else begins to shake. So let's start with the basics, because I want everyone watching this to fully understand the magnitude of what we're dealing with. HSBC isn't just any bank. We're talking about one of the largest financial institutions on the planet, with roots going back to 1865 and operations spanning virtually every major financial center in the world. When HSBC moves, markets notice. When HSBC panics, which is what appears to be happening right now, that's when you need to pay very close attention, because institutions of this size and sophistication don't panic without extraordinarily good reasons. The London Bullion Market Association, or LBMA as it's commonly known, has been the global center for precious metals trading for well over a century. This isn't some fringe operation or secondary market we're talking about. The LBMA facilitates the clearing and settlement of the vast majority of global gold and silver trades. When you hear about gold prices being set, they're often referring to the London fix, which happens twice daily through the LBMA system. Major banks, central banks, mining companies, refiners, and institutional investors all rely on the LBMA infrastructure to conduct their precious metals business. It's the backbone of the entire industry. Now, here's where things get interesting and more than a little concerning. The LBMA operates on what's called an unallocated basis for most of its transactions. What does that mean in plain English? It means that when you buy gold or silver through the LBMA system, you're not actually getting specific identified bars of metal allocated to you personally. Instead, you're getting a claim on a pool of metal that the bank holds. It's similar to how fractional reserve banking works with regular currency. The bank doesn't need to have 100% of the physical metal backing every single paper claim, because under normal circumstances, not everyone tries to redeem their claims at the same time. This system works beautifully when confidence is high, and redemption requests are manageable. But what happens when that confidence starts to erode? What happens when suddenly a lot of people or institutions start wanting to convert their paper claims into actual physical metal? That's when you get what's known in financial circles as a liquidity crisis. And that appears to be exactly what's developing right now in the London market. The numbers we're seeing in these reports are genuinely staggering. 7.3 billion ounces is an almost incomprehensible amount of precious metal. To put this in perspective, total global gold production in an entire year is roughly 110 million ounces. We're talking about a position that dwarfs annual production by a massive margin. Even if we're talking about silver, where production numbers are higher, this still represents an enormous exposure that would take years to unwind under normal market conditions. The fact that HSBC is apparently trying to exit this position by January 31st suggests this is anything but a normal market condition. Let's talk about what could drive a major bank to issue what is being described as an emergency board directive. Banks at this level don't make hasty decisions. They have entire departments filled with risk managers, quantitative analysts, and strategists whose entire job is to model out scenarios and manage exposure. For the board of directors to get involved and issue emergency directives, we're talking about a situation where normal risk management protocols have either failed or revealed something so concerning that immediate action is required regardless of the market impact. One possibility that many analysts are discussing is the potential for a massive default somewhere in the chain. The precious metals market involves an intricate web of counterparty relationships. Banks deal with other banks, who deal with vault operators, who deal with refiners, who deal with miners and recyclers. If one major player in this chain becomes unable to deliver physical metal when required, it creates a cascade effect throughout the entire system. Imagine a game of musical chairs, where suddenly someone realizes there aren't nearly enough chairs for the number of people playing. The music is still going, but smart players are already looking for their seat. Another scenario involves regulatory pressure or changes in how banks must account for their precious metals positions. In recent years, there's been increased scrutiny on the unallocated metal system and discussions about requiring higher levels of physical backing for paper claims. If HSBC has received indications that regulatory requirements are about to change dramatically, they might be scrambling to reduce exposure before new rules take effect. The January 31st deadline could align with some regulatory implementation date that hasn't been widely publicized yet. There's also the geopolitical dimension to consider, and this is where things get really interesting from a strategic standpoint. We're living in a time of increasing tension between Western financial systems and those of other major powers. Countries like China and Russia have been steadily accumulating physical gold for years, moving it out of London and New York vaults and into their own sovereign storage. If there's been a sudden acceleration of this trend, or if major sovereign entities have started demanding physical delivery of their LBMA holdings, it could create exactly the kind of liquidity squeeze that would force a bank like HSBC into emergency action. Think about the mechanics of what happens when physical delivery requests spike. The bank has to actually source the metal, arrange for secure transport, verify purity and weight, and coordinate delivery logistics. This isn't like electronic banking where you just move numbers on a screen. Physical precious metals take time to move, especially in the quantities we're discussing. If HSBC is facing a situation where delivery demands are exceeding their ability to source and deliver metal, they have two choices: default on their obligations or frantically reduce their exposure by any means necessary. It appears they've chosen the latter. Now let's talk about what this means for the broader LBMA structure, because this is where the systemic implications become truly concerning. The LBMA is built on trust and confidence. Participants believe that their paper claims are backed by real metal that they can access if needed. But what happens when one of the largest clearing banks in the system essentially declares that they need to get out of their positions as quickly as possible? It sends a signal to every other market participant that maybe things aren't as solid as they thought. It raises questions about whether other banks might be in similar positions. It creates uncertainty, and uncertainty in financial markets tends to become self-fulfilling. If word spreads that HSBC is having problems with its precious metals book, other institutions might start reducing their own exposure as a precautionary measure. Investors who thought they owned gold or silver through the LBMA system might start requesting physical delivery just to be safe. Mining companies and refiners might become more cautious about extending credit or entering into forward contracts. The whole system starts to contract, and as it contracts, the underlying problems become more acute. It's a classic doom loop scenario where the attempt to fix the problem actually makes the problem worse. We need to consider what this means for price discovery in the precious metals market. Right now, the prices you see quoted for gold and silver are heavily influenced by trading that happens through the LBMA system and other paper markets like COMEX futures in the United States. These paper markets have vastly more trading volume than the physical market for actual metal. But what happens when confidence in the paper market erodes? Historically, we see divergence between paper prices and physical prices. The premium you have to pay to actually get your hands on physical metal starts to rise above the quoted spot price. In extreme cases, physical metal can become difficult to obtain at any price, while paper markets show relatively modest price movements. This divergence is absolutely critical to understand because it affects everyone from individual investors trying to protect their wealth to central banks, managing their reserves to industrial users who need precious metals for manufacturing. If the LBMA system is genuinely in trouble, we could see a scenario where paper claims become heavily discounted relative to physical metal. Your LBMA gold certificate might say it's worth a certain amount, but if you can't actually convert it to physical metal, what's it really worth? This is the nightmare scenario that keeps precious metals investors awake at night, and it appears to be moving from theoretical possibility to practical concern. Let's also examine the timing of this January 31st deadline, because timing is rarely coincidental in financial markets. We're at the beginning of a new year, which is when many institutional portfolios go through rebalancing and risk assessment. It's also when new regulations often take effect, and when fiscal years reset for many organizations. If there's a confluence of factors, regulatory changes, fiscal year-end accounting, contract expiration dates, or delivery deadlines, that all converge around the end of January, it could create the perfect storm scenario. where HSBC feels they have no choice but to exit their positions before that deadline hits. There's another timing element to consider related to physical delivery logistics. The precious metals market operates on very specific delivery schedules and settlement cycles. If HSBC knows that a wave of delivery requests is scheduled to hit in early February, they would need to have their positions squared away before those requests come due. The alternative would be defaulting on delivery obligations, which for a bank of HSBC's stature would be absolutely catastrophic for their reputation and potentially existential for their precious metals operations. Now, I want to address something that's probably on many of your minds. Is this the end of the LBMA? Is the entire London precious metals market about to collapse? The honest answer is that we're in uncharted territory. The LBMA has weathered storms before. It's survived financial crises, major defaults by individual participants, and periods of extreme volatility. The system has shown resilience over its long history. However, we've never quite seen a situation where one of the largest clearing members appears to be in emergency exit mode with this kind of timeline pressure and this magnitude of position. The LBMA's survival likely depends on how other major participants respond. If other large banks step in to take over HSBC's positions and provide liquidity, the system could stabilize. Central banks could potentially intervene to provide physical metal or to backstop the market with guarantees. Regulatory authorities could change rules to ease pressure or provide forbearance. There are mechanisms that could be deployed to prevent a complete collapse, but all of them require coordination, confidence, and time. The January 31st deadline suggests that time might be the one thing we don't have. For individual investors and regular people watching this unfold, the question becomes, what do you do with this information? How do you protect yourself in a situation where one of the foundational structures of the precious metals market might be experiencing serious stress? This is where personal financial decisions get complicated because everyone's situation is different, but there are some general principles worth considering. If you own precious metals through the LBMA system or through financial instruments that rely on LBMA pricing and settlement, you need to understand exactly what you own. Do you have allocated metal with specific bar numbers assigned to you in a specific vault? Or do you have unallocated claims that are essentially IOUs from your bank? There's a massive difference between these two types of ownership, especially in a crisis scenario. Allocated metal is yours, regardless of what happens to the bank or the broader system. Unallocated claims make you an unsecured creditor of the bank, which is a very different risk profile. For those who believe that precious metals should be part of their wealth preservation strategy, the current situation reinforces the old saying in the gold community, if you don't hold it, you don't own it. Physical possession of precious metals eliminates counterparty risk entirely. You're not dependent on a bank remaining solvent or a clearing system functioning properly. The trade-off is that you have to deal with storage security and the inconvenience of physical possession, but in exchange, you eliminate the systemic risks we're discussing right now. However, it's also important to maintain perspective and not panic into decisions that might not be appropriate for your situation. The precious metals market has experienced stress before and has continued to function. Even if we see significant disruptions in the LBMA system, there are other markets and other mechanisms for trading and owning precious metals. The world doesn't end because one particular market structure experiences problems. It adapts, evolves, and finds new equilibriums. And what we're potentially witnessing is a transition moment in how precious metals markets operate. If the traditional unallocated system proves to be unsustainable under modern conditions, with modern participants and modern demands for transparency and physical delivery, the market will evolve towards structures that better meet those demands. This might mean more emphasis on allocated accounts, more transparent vault auditing, blockchain-based tracking of physical metal, or entirely new market structures that we haven't even conceptualized yet. The broader economic context matters enormously for understanding why this is happening now. We are living through a period of extraordinary monetary policy, with central banks around the world having printed enormous amounts of currency in response to various crises over the past 15 years. When currency creation accelerates, people historically turn to hard assets like precious metals as a store of value. This increased demand for precious metals, combined with growing skepticism about financial institutions and paper claims in general, creates pressure on systems like the LBMA that rely on fractional reserves and trust. We're also seeing a fundamental shift in the global economic order, with emerging powers challenging Western financial dominance. Countries that were previously content to hold their reserves in dollars and treasury bonds are diversifying into physical assets, including gold. When these sovereign entities come to the LBMA and say, we want our gold delivered to our own vaults in our own countries, it creates physical flow demands that the system may not have been designed to handle at this scale and pace. The technology sector also plays an interesting role in this story. Blockchain and distributed ledger technology have made it possible to create new types of gold-backed digital assets that promise the convenience of electronic trading with the backing of actual physical metal. These new competitors to the traditional LBMA system might be drawing business away and highlighting the limitations of the older unallocated model. If HSBC sees the writing on the wall that the future of precious metals trading looks different from the past, their emergency exit might be as much about strategic repositioning as about immediate crisis management. Let me also address the information environment around this story because that's important for understanding what we actually know versus what we're speculating about. The details about HSBC's emergency board directive and the specific 7.3 billion ounce figure come from reports that are circulating in precious metals, analyst communities, and alternative financial media. Major mainstream financial news outlets have been relatively quiet about this story, which in itself is interesting. Sometimes mainstream silence indicates that a story is exaggerated or unreliable. Other times, it indicates that a story is so sensitive or complex that mainstream outlets are still trying to verify details or are being cautious about reporting something that could trigger market panic. In situations like this, it's crucial to remain skeptical while also staying informed. Look for confirmation from multiple independent sources. Watch for official statements from HSBC or the LBMA, though recognize that official statements are often carefully worded to avoid causing alarm even when serious problems exist. Monitor actual market behavior in terms of premiums for physical metal, delivery times from dealers, and whether you are seeing unusual trading patterns or price movements that would be consistent with the stress scenario we're discussing. The precious metals market has always attracted a certain amount of sensationalism and conspiracy theorizing, which makes it harder to separate signal from noise when real issues do emerge. The challenge for anyone trying to understand this situation is to remain grounded in facts and evidence while also recognizing that major financial institutions and market structures can and do experience serious problems that aren't immediately apparent from public information. The 2008 financial crisis taught us that seemingly stable major institutions can be far more fragile than they appear, and that problems can remain hidden until they suddenly become catastrophic. As we move toward this January 31st deadline, there are several things to watch for that will tell us whether the situation is genuinely critical or whether it will be resolved without major market disruption. First, watch for any official announcements from HSBC about changes to their precious metals operations or services. Banks don't like to admit problems, but if they're forced to acknowledge operational changes or limitations, that's a strong signal. Second, monitor physical metal premiums and availability from dealers. If premiums start spiking or dealers report difficulty sourcing inventory, that indicates stress in the physical market that could be related to the broader LBMA situation. Third, pay attention to any unusual price behavior in precious metals markets, especially divergence between different markets or between paper and physical prices. Fourth, watch for news about other LBMA members or major precious metals banks. If HSBC is experiencing problems, are others in similar positions? Fifth, monitor any regulatory announcements or changes in rules governing precious metals trading and clearing. Sometimes regulatory changes happen quietly but have massive market implications. The ultimate question that everyone wants answered is what happens next. Do we see a complete collapse of the LBMA system? Does HSBC successfully exit their positions without triggering broader panic? Do other institutions step in to stabilize the market? Does regulatory intervention prevent a crisis? Or do we witness a fundamental restructuring of how precious metals markets operate globally? The honest answer is that we're watching this unfold in real time, and the outcome depends on decisions being made right now by major financial institutions, regulators, and market participants around the world. What's clear is that this situation represents a stress test for the precious metals market infrastructure, and stress tests have a way of revealing weaknesses that were hidden during normal times. Whether those weaknesses lead to collapse or to constructive reform depends largely on how the key players respond over the coming weeks. The January 31st deadline is approaching rapidly, and one way or another, we're going to get answers about the health and sustainability of the current precious metals market structure. For anyone who has made it this far in this analysis, thank you for sticking with me through this deep dive. This is complex material that doesn't lend itself to simple explanations or easy answers. The precious metals market sits at the intersection of finance, geopolitics, monetary policy, and human psychology around value and trust. When systems at that intersection experience stress, the ripple effects can extend far and wide throughout the global economy. Whether you own precious metals or not, whether you think gold and silver are wise investments or relics of a bygone era, you should care about the stability of major commodity market infrastructure, because instability in one market tends to spread to others. We're living through a fascinating and somewhat terrifying moment in financial history where multiple systems that seemed permanent and stable are showing signs of strain. The question isn't whether change is coming to how we organize our financial systems. Change is inevitable. The question is whether that change happens in an orderly, managed way or through crisis and disruption. The HSBC situation and the broader questions about the LBMA might be an early warning sign of disruption ahead, or it might be a temporary problem that gets resolved through behind-the-scenes coordination and crisis management. Time will tell, but the fact that we're even having this conversation should make everyone pay closer attention to the foundations of our financial infrastructure.